Hi, everyone. Welcome back to the SoFlo Real Estate Show. Ask Athena Anything. My name is Athena Barrocas, and I am your trusted realtor here in South Florida. My guest is Greg Wareham, trusted loan officer, my favorite loan officer here in South Florida from the Federal Savings Bank. Hi, Greg. Nice to have you here.
Thank you for having me, as always, Athena.
Yep. And today's topic is what's going on with the interest rates. And it's so apropos because this month on the 17th, the Fed is hopefully going to make a change that's going to be beneficial to all of us. So, Greg, again, thanks for being here. And I'm really excited to talk about this topic, especially with you, with all of the insight that you bring.
Yeah, well, thank you, Athena. I mean, it's an interesting time right now. So we have the Fed meeting on the 16th and the 17th of September. They'll come out with an announcement about what they're going to do with the Fed overnight lending rate, which has really been at 4.25 to 4.5 for over a year now. And I read something on Friday where the Fed chair finally said they're considering dropping interest rates. So he's bowing
Wait
down to
a
some
minute.
pressure.
Finally?
He finally said something that was positive. So
let's hope so.
So it's really been interesting on the mortgage interest rate front. There's about statistically, there's a 95% probability that interest rates are going to come down. And I think it's only because you can't say it's 100%. I think what's going to be more interesting to see is how much does the Fed reduce the interest rates by? What we're seeing in the marketplace for mortgage interest rates, which are really driven by the 10-year Treasury bond yield, we're seeing that market start to react to a potential rate cut. So you're starting to see those interest rates get baked into the market with the 30-year fixed average rate right now at about 6.5%. Now, when the Fed meets, we'll see how much they drop rates by. Because if they drop them more than 0.25%, that's going to be really good for the interest rate market on the mortgage side.
Yeah, it will be. You know, that we've been in what the analysts call a glacial moving market since really January of 2024. Greg, can you bring us back to that period of time and just kind of give us an overview of, really what took place in January 24 compared to January 25 and why the market seems stuck for so many buyers? What happened? What's going on?
It's been a bunch of different issues. I shouldn't say issues as much as situations that have popped up. So if you go back to the beginning of 2024, the big thing that the Fed was focused on was inflation. And we've all heard it and we've all seen it, right? No matter where we're shopping, we're seeing that prices have went up. So the Fed was very hypersensitive to inflation. And at that time, inflation rates were over 3%. Now, a standard playbook in the Fed's handbook is, okay, if inflation is going up, we want to decrease the accessibility to money. And you do that by increasing that federal overnight lending rate to try to stave off that inflation. Now, when we look at last year, didn't really drive interest rate. It really kept interest rates sort of steady. Beginning of the year in 2024, they were in the sixes, jumped up into the sevens. We saw one period of time over the course of the past 12 months where they were closer to 8%. But since that time, you've seen a steady decline for the most part. And that's for big reasons because we've seen inflation come down a little bit. So inflation rate's 2.7%. The Fed target rate is 2%. So that's why the Fed's been so standoffish with dropping interest rates. Now, the other component to that, from my perspective, that's almost even more important right now is unemployment. So we've been in these historically low unemployment patterns ever since we came out of COVID. And when you have people working, there's a lot of money that's flowing through the economy. And that also can put pressure on inflation, right? You can see inflation go up as well in those situations. Unemployment rate right now is 3.8%, but it was 3.8%. It's risen to 4.2%. Now the Fed looks at that and they say, all right, well, we have unemployment starting to rise. Go to the handbook. Okay, when you see unemployment rising, that's when you start to reduce interest rates. And I will say, no matter what anyone's political agenda is, it's a really hard time, right? Yeah. Because you have unemployment going up and you have inflation still isn't where you need to be. And what's the fine balance in there? because we don't want to see stagflation where we see multiple bad variables at the same time with unemployment and inflation.
No, and you know what? Many of our audience doesn't even know what stagflation means. It's been such a long time because really the federal government has been doing a very good job. It could be painful in some times, but they've been doing a very good job in monitoring the economy overall, I would say.
Yeah, I'd have to agree with you on that, Athena. I mean, we all play sideline quarterback with everything. That's what we do, but it's complicated. And you throw in things like tariffs and you throw in global economies, right? I mean, it's very complex situations that we're dealing with at the Fed, at the government level, just across the board.
It's true. And you know, you just said something, tariffs. So as we were coming off of 2024, there was a lot of sentiment. There was a lot of confidence in the market that as we went into January of 2025, we were going to see a much different housing market. We were going to see a housing market that was a little bit more robust. As I mentioned, glacial moving market was the trend for 2024. And when we went into 2025 with that optimism, and again, we don't talk politics. However, there was an item that came up, which was the tariff, right? And that took the housing market a little sideways. It took the business industry a little sideways. Do you want to talk a little bit about how the tariffs may have affected the interest rates, this year?
In my opinion on tariffs is you start to see these tariffs get overlaid. And I think that can cause some pressure on inflation, right? Inflation can go up because the cost of goods are going up simply by tariffs being in place. As far as the long-term agenda with tariffs, sometimes it's hard to tell what is an economic tool and what is a political tool at times in the way that the government has functioned over the course of the past decade. And again, it's not political as much as it's really unclear as to what the agenda is. And I think time will tell, right? We have an administration that's been in place for 8 or 9 months at this point. We'll see where everything goes in terms longer term.
Yeah, agreed. And, I think things are starting to settle down because in the 1st of January, there was a lot of unknowns. But now as we work through these 8 months, I think, the market's calming down. The economy is calming down. I think we're starting to really all understand that maybe the impact that we had projected back in January isn't what is the reality of the outcome. And I think the meeting on the 16th and 17th of this month might also give that type of indication as well. So I'm excited to see what happens. But I also want to remind our audience, a 6% interest rate is not horrible either. It's maybe a little bit more expensive because we're still trying to overcome the 3%. But a 6% is somewhat healthy for our economy. So, we're not going to see anything drastic from the feds on the 17th. Do you agree, Greg?
I couldn't agree with you more, Athena. And when you look at everything big picture, to your point, Athena, it's 6% interest rate. That's still low. I think a number where everyone's going to feel comfortable. Hey, give me something with a 5 handle on it, right?
5.95, right?
Right? And now everybody will look to people that have been holding on to those low interest rate mortgages. You're probably more apt to sell.
Yeah.
And feel more comfortable about obtaining a new mortgage at an interest rate that feels a little bit more palatable. Now, the flip side of that is we may see some short-term housing price increase if interest rates drop. Interest rates drop, housing's more affordable. Does that get baked into what people are willing to pay for housing? And that really depends on the market that you're in nationally. If you look at markets in the Northeast, still very tight with inventory, probably going to force pricing up. Other parts of the country, it's a little bit different where there's more inventory. We may not see as big of a battle with that. But even if that were to happen, it's probably short-lived. And when unemployment continues to rise a little bit, and the indication would be that it is going to continue to rise, that's also going to create some equilibrium to the housing market between buyers and sellers.
I agree. It's going to be an interesting time, and I hope our buyers and our audience and our sellers really start to understand the market a little bit better and participate. Hey, before we jump into those 5 segments of the interest rates to give a better idea of how interest rates really kind of fall into place, I just want to remind our audience to go ahead and subscribe, ring the bell, so that way you have the most recent information on what's going on in the South Florida real estate market. So, Greg, you talked a little bit about inflation, but segment number 1 we were going to talk about is inflation. So why don't you give us a little bit of a recap, quick, dive into how important inflation is in the overall picture as the Fed looks at our market today?
You look at overall inflation, it depends on what indice you read. Some take out energy pricing, some take out housing pricing, but it's somewhere between that 2.7 and 2.9% inflation rate. And as we had talked about before, it's important for the Fed to not over reduce the reduction to interest rates because that can spark higher inflation. That's why we'll probably see, to Athena's point earlier, we'll see some glacial movement in these interest rates coming down and organically working itself out. So it's something to keep an eye on. The good news is inflation it's palatable and manageable. And it feels like, at least based on what I saw at Costco last week, it looks like things are at least stabilizing.
Yeah, Costco. But you're right. Inflation is a key hurdle. I think it's the number 1 hurdle for the Fed to look at. But as you mentioned, it's manageable right now. So hopefully that will lead a little credence to a movement that's a little bit more welcoming to our audience. Let's go on to the second segment, job report. How do you feel the job report is coming in? And do you feel that it is also a manageable moment in time?
Yeah, I mean, well, we saw the jobs report was actually amended a couple of months ago, or in the past 45 days, showing that new job creation was significantly lower than what was originally projected, to the tune of 100,000 less jobs had been created. And that is a sign of the economy slowing down and jobs being less accessible to people. And, in the normal market, you're going to see 2 jobs or you see 2 candidates for every 1 job. And we've seen that change a little bit, where there's more jobs than there are people to fill them. And hopefully we start to see that stabilize a little bit, because it's good for the overall long-term economy.
Oh,
and we've
good.
been in a bull run with unemployment.
We have been. You're right. We have been. It's been
Since we've
pretty.
come out of COVID, it's just been a very, very robust job market, which is great for everyone. And wages have been up as well. So that's a good thing.
You know what? Wage resilience has been very strong, and that is a very good thing. And so I'm sure the feds are going to be looking at wages as well as the resilience in the overall labor market. So I think it's a pretty positive time we are in right now. This could change in October, it could change next week, but today it seems very, very positive. Okay, big question. Our segment number 3, the Fed movement. Where do you see us going with this?
I think they will reduce the industry. We think the rates will reduce by 0.25% when the Fed meets or makes their announcement on September 17th. So everyone's on the same page about that. That federal overnight lending rate, that's the bank at which banks charge each other to borrow money, or you're borrowing money from the Fed. It is not a direct correlation to the mortgage interest rate market. A mortgage interest rate market is more driven by the 10-year Treasury bond yield. And that's important to know, because when you hear rates have been dropped by 0.25%, it doesn't mean rates went from 6.5 to 6.25% on a 30-year fixed overnight. It does have an indirect impact on it, where you see these rates start to organically come down as the Fed reduces the cost to borrow.
Yeah, and that's important because it's very difficult. It's a very complex discussion on, the rate movement and what's in the media and what's in reality. And I think it's just, an overall kind of Cliff Note version, if most of our audience remembers the Cliff Notes, is that when we see the movement in the Fed, as you mentioned, there is an indirect correlation to what's going to happen in the market. It's not percent by percent or dollar by dollar, but it's an overall trending. And I thank you for reminding us about that, Greg, because it does get very confusing.
Yeah, and you know what, Athena, it's important too not to read the media hype, and it's hard not to. I read something within the past couple of days that interest rates were at their lowest point since October of 2024. Well, not really. We
Not
saw
really.
we
I
saw a
think I read the
reduction over
same
the course of this
article.
year, right? So it's not everything's relative to a perspective of who's printing that article or making that statement. But I would also take it with a grain of salt. And you need to talk to Athena. You can talk to someone like myself who could better educate you on what indicators to really look at.
Yeah, good point. Good point. I watch the media as well. I can't help it. It comes onto my phone. And I'm just like, oh, interesting. The highest rate, lowest rate, highest rate, lowest rate. We get this highest and lowest rate like once a month, but
Right.
I don't know what they're comparing it to. So it's really interesting. Let's talk about segment 4 and what change in the rate does this really have as far as an impact on the housing market, on real estate? What do you see that really driving?
Yeah, again, not a direct correlation when the Fed drops the interest rates, but it's good for the overall mortgage interest rate market longer term. Yeah, if we see organically the Fed starting to reduce interest rates, you're also going to see long-term interest rates, 10-year Treasury bond yield likely to reduce as well, lowering those mortgage rates.
Greg, can we talk about a specific example? I know this
Sure.
is hard, but let's take an example. Say the interest rate, well, what is the interest rate today?
6.5,
6.5. All
30-year
right.
fixed.
So if it goes from 6.5 and we have a standard $500,000 home, right? And we're going to use the 20% down with the caveat that most people don't have a 20% down. It's just easier for our calculations. Okay. With a 20% down, and we have a 6.5 and it goes to 6.25. How much more purchase power does a buyer have per month?
Dina, I love it when you make me get my calculator out.
What? You're not doing this on the top of your brain? This would be
Oh,
like an
let's go.
automatic.
So in that example, with 20% down on a $500,000 purchase, that means you'd have a loan amount of 400,000. When you look at the difference in payment between a 6.5% interest rate and a 6.25% interest rate, your difference in payment is going to be approximately $65 a month. Then the question becomes, okay, $65 a month, what does that afford me in the form of mortgage? It's about an additional $10,000. That's how much it
Okay.
would move by.
All right. So, you know what? I'm going to take this on both sides, Greg, and I want you to work with me. All right. $10,000 could be a lot of money to somebody, right? It could be a lot of money to our buyers. It can get them into the home that they really want to buy. So that's very important. On the flip side, $65 a month is not a lot of money to hold off in buying a house today, waiting for the interest rates to drop.
That's a
Thoughts?
great point. Yeah, that's such a good point because here's what you need to compare that against. So 0.25% reduction in our example, $65 a month, $10,000 that equates to in a mortgage. Well, if interest rates drop and the perception in the marketplace is this is a great thing, increasing demand for real estate, demand increases for real estate, housing prices go up for real estate, at least short term. Now, does the housing price go up by more than $10,000 because you waited? Or you buy now at 6.5%, feeling that long term rates are going to organically go down anyway. You lock in at a price that's lower, and you can always refinance the mortgage and save as a result of that.
Yeah, it's a sticky balance. So this is why I say all the time, if you're thinking of buying a home, contact your lender, contact your realtor, because these conversations and building a strategy can change your whole thought process. Listen, Greg, I had a client just recently and they're like, Athena, this is when the rate was almost 7%. Athena, we can't pay 7%. I said, okay, why? Why can't you pay per 7%? We don't want to. Okay. So let's talk about how much is this going to save. It was a Starbucks coffee a day, Greg, that they wanted to wait to save money for. And at the end, they did buy the house because if you can afford a Starbucks coffee a day, then you can afford to buy this house today? And it's all perspective, it's media hype, it's all of this outside influence and these voices all around that tell people what they should do and what they shouldn't do. But at the end, it should be their decision based on the real factual numbers and what the market is allowing or disallowing them to do. I'm sure you have an example as well.
It's so true, Athena. And as you're saying that, I'm also thinking about potential tax deductibility of that interest. So, all right, rates a little bit higher. Rates are higher than anyone wants them to be. And until they come back down to 3%, they're always going to be too high because we had that moment in time where that became an expectation for a couple of years. Are we going to go back there? Probably not, or at least not in the foreseeable future at all. But you also have to keep in mind that these higher interest rates also increase higher tax deductions potentially when you speak to your CPA about that, which can reduce your adjusted gross income, which can change your tax liability or return at the end of the year. So there's just a lot of different factors on it.
Yeah, there are so many factors other than what's the interest rate. So again, I encourage our audience to go ahead and book an appointment with us, and that way we can talk a little bit more about what their strategy is. Let's go into segment number 5. This is always a fun one to me, and that is, what is the future forecast? What does the future look like for us, Greg, in the world of mortgage rates?
My opinion on it is we start to see slow declines. I love the expression glacial movement because that's really what we're probably going to see. And I think as we get into the middle of next year, excuse me, that's when we'll start to see more consistent rates back into the fives. So, but it'll be a slow moving pace. I just don't think we're going to see anything drastic unless something drastic happens in the marketplace. An example, unemployment goes from 4.2% to 6%. Well, that's significant. And that type of significant situation creates a significant action by the Fed and it impacts the market.
Yeah.
But if we just keep going along the way that we are, it'll just be a nice organic flow.
Steady wins the race at the end of the day. Look, you and I have been through many different markets in our real estate careers. We've been through some really great markets. We've been through some wild rides. We've been through the unicorn years of COVID. We've been through, the housing crisis. We've been through so much. And this is what my takeaway is. I would rather have that steady, slow, glacial movement up, down, whichever direction it's going to go, versus a bold move. Every time there's a bold move in the market, it's never good. It's never been good. So I don't want to see the Feds ever come out and say rates went from 6 to 3% again, because that's going to indicate something very, very bad just happened.
Yeah, couldn't agree with you more, Athena.
We
Slow and
definitely
steady.
do not want that. No, absolutely not. So I appreciate your thoughts on this and taking us through those 5 segments, Greg. It's really, really good. And what would you consider the best strategy for a buyer today?
Become educated, understand what's going on in the marketplace, and also determine what your budget is from a monthly payment standpoint. Try not to get hung up on where the interest rates are at this point in time. Make sure that the home ownership process for you, it's the right time, it's the right thing that you need to do. You can always refinance your mortgage. One thing I'd throw out there is, I think if you were to ask anybody what's one of the biggest financial mistakes that they ever made, and Athena, you can relate to this. Everyone says they wish they bought more real estate, because the real estate market in the United States will have its ebbs and its flows. Long term, real estate over the past forever has been a great return on investment. And I think that's something to keep an eye on. People that buy today, 10 years from now, will be happy that they bought today.
It's
Just like 10 years of
absolutely
the 10 years
true.
prior.
It's absolutely true. Listen, I'm talking to a friend of mine, and she so much wants to retire, right? And you know what her statement was? And we're going to fix it, of course. She said, if I only had one more rental property, Athena, I could retire today. I said, why didn't you do it? She goes, time went by on me. So you're right. create that moment, create those strategies, and work with a professional. It's so important. So, Greg, I'm going to recap those 5 segments on interest rates real quick, and then we're going to get to our 5 FAQs. So be ready. Here we go. So the takeaway from this in the 5 segments, one is inflation is a bit above target, but manageable. Jobs are softening, and then some resistance remains. The Fed meeting mid-September is likely to bring a small outcome. It's hopefully going to give us the right trending that we all need and the confidence we want in order to continue to buy and sell homes. Mortgage rates, look, T-bills, not the Fed movement. Thank you, Greg. I think that was a huge takeaway. And homeowners and buyers, they are benefiting from the movement in today's market. 2025 has been a good year. We just all have to get our heads wrapped around it a little bit. So thank you for those 5 wonderful segment discussion points, Greg. Are you ready to move on to our 5 FAQs? This is the hot seat. All right, here we go. First of all, what is the current average 30-year mortgage rate?
So it's currently 30-year average currently sits at 6.56%. 30-year fixed with no points.
Okay. Not a bad rate, people. I like it, especially if, you can afford that extra cup of Starbucks coffee along the way.
One thing I would throw out there, Athena.
What's that?
One thing I would throw out there. So here's what drives it. Which credit grade and how much is your down payment? What percentage of the value of the property that you're putting down? So it can vary a little bit.
Perfect. Will the mortgage rates drop when the Fed rate cuts their when the Fed makes their cut?
Will they drop? It depends on how much the Fed cuts the rate by. I do think that we've already seen a 0.25% reduction by the Fed that's anticipated getting baked into the mortgage interest rate market. So I wouldn't expect a massive change on the 17th unless the direction of the Fed's more aggressive with rate cuts than what was expected.
Okay. And what about by the end of the year? Do you see more rate cuts coming? Do you think the Fed will make another cut?
I do.
You do.
Yeah, I do. I think it's time, and I think the cost of money's just been too high now for 3 years. I do think you'll see it organically go down. They want to keep the economy stimulated.
Okay, here's number 4. Will the real estate market pick up by the end of the year? Are we going to see a lot more activities from buyers coming in and wanting to buy homes?
It's a great question. I think that we'll see a run here from September into probably the middle of November, and then traditionally it's going to slow down a little bit as you get into the holiday season. I felt that Athena and I were talking about this earlier. I felt that August was kind of slow for new people coming into the market. So there weren't a lot of new people becoming pre-approved for a mortgage in August. I think we see that trend reverse over the course of the next couple of months, and then we'll slow down, of course, at the end of the year.
Okay, last question. Should I wait to buy a home this year and wait for the rates to come down in 2026?
I just wouldn't base my decision to buy a home based on where our current interest rate is. As we've said many times, you can always refinance your mortgage to drop that payment, but at least you know how much you're paying for the property. I get a little bit concerned if we see interest rates drop, demand increases, and pricing goes up. That's a little bit of a concern, but I wouldn't base it on that. I mean, no one in the history of ever has timed anything perfectly when it comes to the markets. Never's a long time, but you get my point on it. The probability of being able to do it's very low. So you buy a house because you need a house, because you want a house, because it's the right financial investment for you, a family, single person, whoever. I wouldn't get too hyper focused on current interest rates and making that decision.
Wonderful. Thank you, Greg. And we're going to wrap up right now. But before we do you have any last words of wisdom?
No, that's it. I mean, I would encourage everyone, again, just be educated. It's the number one thing you're looking to do. The other thing that I would say is if you are a first-time home buyer, be patient. Your time is coming. I mean, I read a report this week, 24% of all buyers were first-time home buyers this year. It's the lowest ever with an average age of 38. Your time's coming, the market's going to change, and you're going to have your opportunity. So just hang in there and keep focused on saving money and maintaining a really strong credit rating.
I love that. I love that motivation at the end, Greg. Thank you so much. Thank you for being here. And for our audience, we both invite you to book an appointment with us or drop us a DM, and we would love to answer your questions. Home ownership is something that Greg and I are definitely dedicated in helping our clients get to where they want to be. So, Greg, thanks again for joining me. Have a beautiful day.
Thank you so much for having me.